It's taken 15 years for the NASDAQ, the U.S.'s tech-heavy equity index, to reach its peak. Now a trend, though, is that overvaluations have some worried that a bubble could soon be created. Clemens Aichholzer, an investor and tech entrepreneur, shares his thoughts. So in general, do you think that the price-to-earnings ratio is sitting where it needs to be when it comes to the NASDAQ, or is it too high?
Well, I think we've seen a very good run, and valuations at this point are quite high, and they price in quite positive expectations. You can look at it at particular stocks. Some stocks do look overpriced, and you would argue that valuations are detached from fundamentals. You can actually see that not only on the public market side, but also throughout the tech investment space, from startups to sort of later stage private financings to the public markets. But I wouldn't go as far as calling it a bubble in terms of valuations. I think what we're seeing is potentially a risk bubble.
Do you think investors in some way have a satiated appetite, that their expectations have been reduced in many ways? Willing to accept that profits are not going to be chased as quickly or come as quickly as has been the case in the past?
I think it's true what you're saying. So there's a very positive financing environment for tech companies, also on the private side. So they're able to raise a lot of money, which basically incentivizes them to take huge risks. In a way, if you're able to raise a lot of money, and you do so, then you have to justify raising all this capital by spending it and by having very large cash burn rates, incurring huge operating losses. That may actually be a very good thing if you want to grab market share very quickly, potentially in a winner-takes-it-all industry. So high cash burn rate per se is not a bad thing. But I think what is important is it needs to be justified for your particular case, and you do need to have a plan B. So you need to have a plan to switch to profitability quickly. Because sometimes what we are seeing is that people take in all this money, they sort of are very much focused on revenue growth and user growth. They push out profitability into the future, and sometimes they do so without having really proven out their business model, and that can lead to bad surprises.
So when they do get to the public market phase, are you and your community of investors here more willing to entertain $1 billion IPO than perhaps your counterparts who are very much laser focused on the New York Stock Exchange or one of the American indices?
Well, I think on the tech side, there's a lot of good things thankfully happening in Europe now, and you can see a lot of very successful companies, and you can also see, which is interesting, companies scaling up in Europe and going from very early startup right to the public markets. And I think this is a very healthy and good development, and also shows that European tech markets, are maturing. It used to be that many successful startups, their instinct was always to move to the US, go to Silicon Valley and scale the business up there, then potentially hope for an IPO on the NASDAQ. That's no longer the case.
So all of this sort of media hype that surrounds the NASDAQ is actually sort of misfocused, because from what you're telling me, I gather that this is actually part of a larger trend. It's sort of a tacit acceptance that when it comes to tech valuations, hitting the $1 billion mark is not that surprising and uneventful. And in fact, it's aspirational for those listing on other stock exchanges or even looking for private financing.
It used to be if you want to raise a significant amount of money, you would have to go public. That's no longer the case. Given the strength and the competitiveness in the late stage private financing markets, you can actually delay your IPO and raise a lot of money at that stage. That implies, I would say, meaningful advantages for the company, because they do face less scrutiny in public markets. Every stone is being turned, and you're facing a lot of due diligence also when going through the IPO process. And you also don't have to deal with the infamous short-termism of the public markets. So you see a lot of billion-dollar valuations for tech companies that haven't made it to the market yet because they're just pushing out that state.
There's this other trend that could potentially have sea change when it comes to markets evaluations. That's Chinese tech companies moving away from listing on the NASDAQ, and in fact going back to China because of foreign company rules that are changing within the Chinese government, right? So what that tells me is if these companies are no longer listing, the Alibabas of China are heading back to their native land to list, what does that say about the larger implications to the industry? And will that have an impact on billion-dollar valuations?
Tech has become a global phenomenon. It started, if you want, in Silicon Valley, and it used to be the case that every company sort of needs to be based there and sort of needs to grow from there. Now we don't see that anymore. So if you're a Chinese company or if you're a European company, you have a very good option basically staying in your own region, which may make more sense from sort of a business model perspective. And now you also have the financing ecosystem to justify such a decision.